Hello and welcome to this fresh new edition of MF Corner. I am Sonal in the Mumbai studio. So today on the show, we'll be focusing on gilt funds. This is not a category that we talk about very often, but it's interesting to understand because there's been a lot of focus on this category since the budget announcements. So will this be the right time to invest in gilt funds? Is it the best category to play the improvement in yields right now? And also considering the rate cycle that we are in. We saw the Fed cut rates, but there is an expectation that even RBI would do that. So where are we really in that rate cycle, and how can you look at investing into gilt funds? We'll discuss this and more with Joydeep Sen, who's the corporate trainer and author, and Abhishek Bisen, who's the head fixed income at Kotak Mahindra AMC. Let's start with you, Joydeep, first up. Always a pleasure speaking with you, and thank you so much for joining in on the show today as well. As I was pointing out earlier, there's been a lot of interest in the category since the budget announcement. Is it the right time to invest in gilt funds?
So thanks, Sonal. So there are two approaches to it. One is the timing bit, like you just elucidated about the rate cut cycle. And the other approach is long-term. Now let me clarify on these two. If you are playing the long-term game, just to give you some data, over the last 10 years on CAGR basis, gilt funds have given 7.77% in the regular auction. As against that, dynamic bond funds have given 7.33% and corporate bond funds have given 7.25%. So what I mean to say is, even without any default risk, gilt funds have given superior returns. Now coming to the point of interest rate cycle, yes, very much. While part of the rally has already happened, scope is still there. Again, some numbers. About a year ago, 10-year gilt was around approximately 7.35%. Today it is approximately 6.8%. So while part of the rally has happened, scope is very much there. The rationale is the RBI is yet to initiate the policy rate cut cycle. We are at the cusp of it. Either in December or in February, the RBI will initiate the rate cut cycle. And to benefit from the rate cut cycle, yes, investors can very much consider gilt funds. Again, just to make a conjecture, 6.8% is the current level. On the initiation of the rate cut cycle, 10-year GSEC yield should breach 6.5%. And why this number? Why 6.5%? Over the last 25 years or so, the average spread means differential, average spread between repo rate and 10-year GSEC yield is approximately 1%. Today it is 30 basis only. Repo rate 6.5% and 10-year GSEC 6.8%. However, on a rally, things can change, sentiments can change. So if repo rate becomes, say, 6% or say 5.75%, 10-year yield should breach 6.5%, and then how much further it will go depends on market sentiments. So if investors want to benefit from this move, yes, they can very much even now consider taking positions into gilt funds.
Okay, all right. So gilt funds, a category that we can look at. In fact, we have Abhishek Bisen, of the head of fixed income at Kotak Mahindra AMC, who is in the studio with us. Abhishek, thank you so much for joining in. Pleasure to have this conversation with you in person. So, as I was mentioning earlier, this category has been in focus since the time budget announcements came by. Do you think now we are seeing increased interest come back in this category?
Yes, definitely. Given the overall scenario emerging in India, we are definitely seeing increased interest. However, it could have been a tad higher. We would have been much more happier.
Okay. Yeah. So what led to that increased interest since budget?
India is a fundamental story which is emerging and which is partially brewed, partially it is yet to get delivered. So what factors we are talking about is the overall fiscal profile, which is improving and which is yet to improve. And if you look at the growth inflation dynamics, which is quite favorable, current scenario in the near term may not be, but over a period of time, definitely yes. So if we just join the two, we believe that it has a potential for a rating upgrade. And if you observe, we have got a couple of index inclusion in the global indices as well, but the large ones are yet to get delivered. So once we have all the dots joined, it is going to be a much bigger story, and we believe the rates are going to be much lower apart from the rate cuts which are likely to get delivered in next 6 months or so.
Okay, so I'll come to the rate cut part as well.
Yeah.
But is it fair to say this could be the right time to invest in gilt funds?
Yes, definitely, yes. It is definitely the right times to invest.
Okay, all right. So I'll come to more details on that one. Joydeep, let me come to you. Have we seen, and this is something that I'll ask you as well, Abhishek, have we seen mutual funds stepping up their bets on longer duration bond funds in that case?
Definitely, yes. So how it works is there's something called modified duration. Modified duration is called the multiplier or sensitivity. So whatever is happening in the market, in the sense in the market, interest rates, yield levels are going up or coming down. The impact of that, the impact of the change in interest rates in the market on the price of the bond or the NAV of the mutual fund depends on the modified duration. So when mutual fund managers like Abhishek increase the portfolio maturity, the portfolio duration also goes up and the fund benefits more. To give you some sense on that, there are certain funds in the gilt category, in the long duration category, and in the dynamic bond fund category have portfolio maturity of more than 25 years and duration of more than 10 years. So how it works is, to give an example, let us say the YTM of a fund is say 7% and the expenses say 1%. So 6% is the net accrual level of the fund. So in the example of 10 years of modified duration, if the yield comes down by 25 basis points, like 0.25%, you have 6% accrual any which way, plus 0.25% into 10, 2.5%. So 6 plus 2.5, 8.5 is your return over a 1 year period. So accrual plus the mark-to-market benefit. So yes, fund managers have stepped up their bets to benefit from the expected rate cut cycle.
Okay, all right. So let me now ask the person who's from the mutual fund industry. Is the industry overall doing that, and what about Kotak's strategy here?
Yeah, so if we look at from the industry point of view, definitely yes, the duration in the gilt space definitely has gone up, but still there is a divided view as always. We as a Kotak strategy, we believe that longer end of the curve is likely to perform much better, and therefore we are quite well positioned on the longest end of the curve in order to get the maximum benefit out of the falling rate story, which is going to emerge over a period of next 6 to 8 months.
Okay, so over next 6 to 8 months is when you think the complete conversion of that story.
We will have most of the points which I was highlighting on the show is going to get, we'll get more clarity and they will get delivered, and which will eventually reflect in the much lower bond yields going forward.
Okay, all right. So in that case, Joydeep, let me come to you. When we talk from an investor's perspective, what time duration does it fall under from that perspective when you have to invest in gilt funds or bond funds for that matter? Is it long term, medium term or short term?
So I'll bifurcate here. Like I said earlier, either long term for the keeps or short term to play the interest rate cut cycle. If you're playing for the long term, don't have to do any timing. You can just fill it, shut it, forget it, horizon of 10 years and longer. On the timing bit, as Abhishek said, next 6 to 8 months, so you can take positions now. And over the next 6 to 9 months, whatever rate cut or rate cut expectations are going to play out completely. And then you can book your profits and move to a lower maturity gilt product, debt product. Over the medium horizon, like say 3, 4, 5 years, I would recommend something like a corporate bond fund or a target maturity fund, and neither the long end nor the short end of the curve. So it's a function of the investor's investment horizon. That's how it is.
Okay. So across different time durations, you can invest in this fund, because usually when it comes to, debt funds or gilt funds, people are slightly more confused on the other part versus an equity category. But Abhishek, since gilt funds do not have a credit risk, is this something which makes it the best category to invest into?
Yeah, so from that perspective, you just need to look at only one factor out of it, and that is just the duration. So you can simply match your investment horizon with the fund and just stay put and ride the curve. But I also would like to highlight one more point here, that you don't need to actually go in and go out. These are actively managed funds, and we have seen durations getting as low as 2 or 1 and as high as 13 or 14. So we have been playing all across the cycles. So if you are just staying put, and you can have the benefit of the higher side and the lower side as well. So you just don't need to remove or take a call on the markets. Just take an asset allocation call, stay put and enjoy the benefits out of it.
You know, exactly, with debt or maybe gilt funds or corporate bond funds, that is exactly what happens. People think it's for a time period or a time frame. And that's why important to have these discussions. Joydeep, comment on the same question. When I say there's a difference how investors perceive equity versus debt, how do we look at gilt funds when there is no credit risk here?
So, to put in perspective, if you look at it now, if you look at the numbers, the mutual fund industry has never really marketed or sold or pushed the concept of gilt funds. Again, to give you some sense on the numbers, if you look at the AUM in the gilt fund industry or the gilt fund as a product, about 42,000 crore. This is less than 3% of total debt fund AUM and less than 1% of total industry AUM. We can debate what is the reason, but if the industry pushes the idea, yes, there is no gilt in gilt. This is a good product to be in. And also, if you look at the number of fund houses, in the gilt fund usual variety means the one we see, there are 21 AMCs with products in this category. And in the 10-year variety meaning 10-year constant maturity, there are only 5 funds in the industry. So it's not a bad idea to push this fund and to market this fund. And for the investor, yes, there is no default risk. You can sleep at peace, just like Abhishek said. If you can marry your investment horizon with the portfolio maturity of the fund, you will be at peace and you will get decent returns over a long period of time.
So, Abhishek, can you comment on this? Why do you think mutual fund industry is not able to market this product generally and the debt category?
So, if I can just add on to what he said. So, there's a volatility factor which comes into the duration space, and typically from debt side, investors are not as comfortable or maybe not able to understand why is the volatility. They are equating this with the equity markets.
Correct.
And that's where they get concerned if the prices are going down, they are probably losing their money, but which is not the case. These accruals take over a period of time and eventually take care of the volatility. So once they are able to appreciate this over one cycle, they are much more comfortable. So this sense is just coming along. So once this is prevailing well and they are understanding the asset allocation part of it, so they are much more happier, and we are seeing this, it is just slowly brewing up, and people are much more comfortable holding gilts as an asset in their portfolio rather than funds, because the funds are mark to market while their holdings are not. So which is again just thought process, and we are trying to change that, and probably hopefully soon we'll see some results out of it.
Okay, all right, take that point. It's a very interesting discussion, gentlemen, but we have to take a quick break. On the other side, we continue our discussion with our guests on gilt funds and what's the outlook going forward. Welcome back. You're still tuned into MF Corner. We still have with us Joydeep Sen, the corporate trainer and author, and Abhishek Bisen, who's the head fixed income at Kotak Mahindra AMC. Well, we've discussed, gentlemen, what is the right time to invest in gilt funds right now would look good. But the big question that remains is how much rate cut is expected now by the RBI? Abhishek, let me start with you, then Joydeep, I'll come to you.
So that's one of the most debated point right now. So we believe that at least 50 basis point rate cuts are going to deliver since we didn't hike as much. Therefore, the cutting story is not as deep as it has been in the other part of the world or likely to be in the other part of the world. And 50 basis point over next 6 months is what we believe is likely to come in.
And there is any risk to that?
Yes, globally a lot of uncertainties are looming, and that's what is holding back our central bank as well. And the cautious approach has paid its own fruits by now, and that's what they are trying to protect. And if you look at the war scenario, if it goes out of hand, or the vegetable inflation or the food price inflation which persists for longer than anticipated, then probably we may have to wait for a while. But doesn't look like it is going to happen.
And let's just hope for the general good of humanity also that the geopolitical tension stop at some point in time. For sure, for the financial markets. Joydeep, come in on this. So what's your take?
It will be a shallow cycle, 50 or max 75 basis point. My rationale is for RBI, the metric is real positive interest rate. So inflation is so much. The RBI projection is 4.5% for this financial year and 4.1% for next financial year. Repo rate currently is 6.5%. So RBI would want to keep so much of real positive interest rate. So provided inflation behaves, but again, as you people discussed, there is an upside risk to inflation as well, which is why it will be a shallow rate cut cycle. The risks, as Abhishek already mentioned, similar, global, geopolitical, India in particular, vegetable inflation. Also, there is another variable in the Monetary Policy Committee. If you look at the composition of the Monetary Policy Committee, this is going to be the last meeting chaired by the current RBI governor. He's retiring on 10th of December. By February, we'll have a new RBI governor with fresh views. One deputy governor also may set to retire in February. And of course, we have 3 new MPC members. So it's about the economics, the fundamentals, the inflation, the real positive interest rates, and also the interpretation of what's prevailing on the ground. But yes, net, since we are today at 6.5% and inflation being maybe in the range of broadly 4+%, 50 to 75 is a reasonable expectation in the rate cut cycle.
Okay, we take that point. So Joydeep, coming on this, is there a further scope of rally in yields from here on then?
Yes, very much. Because we are at the cusp of the rate cut cycle, but yet to start. While part of it has already happened, like I said earlier, 1 year ago, 10-year yield was 7.35%, today it is 6.8%, driven by a multiple of variables, rate cut expectation, inflation behaving, fiscal discipline. So this year, this financial year, the government's net borrowing from the market is actually lower than previous year. In a situation when the country is growing, the budget size is increasing. And then we have FPI investments, not just JP Morgan, we have Bloomberg and we have FDIC as well. So lots of positives going for us. So breaching 6.5%, I won't say given, but yes, that is a very much likelihood. And yes, scope for further rally is very much there.
Okay. You agree with this, that we could see, and if yes, is there any level?
See, level would be difficult to say because there are many factors. And if I could just add on to it what he said, if you just depend on the rate cut cycle, the rate cut typically helps the shorter end of the curve, and we are in a relatively flatter curve. So once the rate cut starts coming in, you will see the shorter end moving more in terms of yields. But since, as I said in the beginning, it's a fundamental story, and there are a lot of fundamental things changing, and which is likely to impact the longer end of the curve because of the demand-supply dynamics in the government bonds. Let's say, for example, the fiscal profile. If the fiscal profile is much better, stronger, it is not just likely to give you a rating upgrade, but at the same time, the supply of the bonds are going to go down. So both these things combined together will give you index inclusion likely to deliver demand for long-term bonds, not from the domestic insurers only, but worldwide. So this is going to bring down the long-term yields probably in line with rate cuts or slightly more.
Okay.
So overall, we are likely to see much lower rates going forward. Yeah.
All right. So, Joydeep, if the objective is to benefit from the rally, which funds would be better suited? My director tells me we have around 2 minutes. So if you could pace yourself accordingly.
So any fund with a very long portfolio maturity and very long portfolio duration, like a fund with 30 years portfolio maturity and 12 years modified duration, will benefit the most, be it gilt, be it long duration, or be it dynamic bond fund. Short answer.
Okay, all right. That was shorter than what I expected as well. But okay, all right. Abhishek, let's end this discussion now because we've been talking about how the industry is looking at debt funds. There's still more focus, or I would say, an invest in equity funds as well. From here on, do you think everything will work in favor of the debt category after the budget announcements, after whatever we've seen last year, whatever taxation changes happen, and now the industry is over all that?
Yeah, so broadly things are in line, favorable, and either we are going to slide down or yields are going to go down. So in all, it's all for the debt category. Obviously, it has its own upsides and downs. So a limited upside, but stability plus upside, if you can say that. So it's good for the debt industry.
And
so
it
far.
provides, it's good for investors to keep in their portfolio in a market which is otherwise very volatile, in equity markets. So good to have allocation to debt funds for that part of your portfolio which weathers all the ups and downs that we are seeing otherwise as well.
Absolutely.
All right, gentlemen, it was such a pleasure to speak to the two of you. Thank you so much for making this complex topic so easy for our viewers. We should have more masterclasses on debt category and the subsets as well. Thank you so much for joining in today. But for now, we'll take your leave on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.